You can't grow a care business if you're afraid of the word finance.
Gross profit and your net profit and your operational income or expenditures, all these things need to be taken into consideration.
When it comes to borrowing, it's not just about asking for money. It's about what you can prove to a lender.
If you speak to a broker and they just say, oh, I can get you 70% without asking any other questions,
walk away. One of the most revealing takeaways from this conversation with Neil is this. From a lender's perspective, your CQC rating isn't just a report, it's a risk signal. It paints a picture that could cost you real money. Contrary to popular belief, buying a care business isn't just for the big players anymore. You've just never been shown the right tools. Your vision alone won't secure your finance. Your numbers have to back you. Hello and welcome back to the Health and Social Care Business Podcast, where we dive deep into stories, insights, and strategies shaping the care sector today. Today, we're talking about something that every provider, whether new or experienced, needs to understand, and that's finance. Specifically, how do you fund growth? How do you buy or even expand a care business? And what tools are out there that most providers aren't using only just because no one has ever explained it to them properly? My guest today is someone with deep experience in this space. Neil is a commercial finance broker whose career has taken him across some of the biggest names in the banking and consulting industry, from RBS to NatWest, Metrobank, EY, and now Christie Finance. Christie Finance is a commercial finance brokerage that works directly with care businesses, from supported living to care home groups, children's services, and even social landlords, to help them access funding that fits their vision. So, whether you're thinking of buying a service, growing one, or just trying to stay financially afloat, this episode is packed with insights for you. Here we go. Thank you, Neil, for joining me today.
Pleasure.
All right. So, Neil, as we usually do, let's start from the beginning. So let's paint a picture of your journey. Could you just tell us a little bit more about you?
as most people, I started off in the bank. Like most people who work for banks, it wasn't the plan. Fell into banking when I was about 18. Initially with Barclays, behind a sort of a care call, taking phone calls from people just asking general questions. And it just went on from there. So Barclays, NatWest, RBS was there as a portfolio manager. So as it sounds, looked after a portfolio of clients. We had a relationship manager who basically used to say relationship manager used to do the relationship, the portfolio manager did the portfolio. Before becoming a relationship manager myself, ended up Metrobank, did some commercial deals there. I went on to working as a consultant before back at NatWest and with HSBC for a little while before becoming a commercial broker, pretty much in the heart of the pandemic. So that was an interesting time. But yes, I've been with Christie Finance now for 4 and a bit years, just over 4 years. 4 years in March. Started off as a finance consultant, then a senior consultant, and now I'm an associate director.
Amazing, amazing. So when I introduced you as a commercial broker in the care space, so when you hear about commercial properties, it just sounds so far away, especially for smaller providers. So could you actually explain what that is?
Well, it depends who you speak to.
Oh, okay.
Yeah, because different lenders, basically a lot of lenders will have what they call personal, business, commercial, corporate, or even larger corporate. And depending on what each of these lenders' credit policies and parameters are, where your business could sit. The general rule of thumb, business goes up to about £500,000. Lending size, if we're talking about lending amounts, up to about 5 million tends to be the commercial sector, again, lending amounts. And then above that goes into corporate. However, some lenders will then throw in a curveball and say it's also down to turnover, complexity of the client, general requirement. As ever with commercial finance, it's not a straight road. There's lots of twists and turns, but generally speaking, £500,000 up to about £5 million worth of debt, you would be deemed as commercial.
Hey, so that takes me next to Christie Finance. So now that you've explained the role, what is Christie Finance? And who are they?
So Christie Finance is the sister company of Christie & Co. Christie & Co. is probably if we explain it, Christie & Co. are first. Christie & Co. sell businesses. They've just had their 95th birthday. So they've been going out a long time. Yeah, 95 years. We celebrated that a couple of weeks ago. So selling businesses, anything from care homes, hotels, day nurseries, and they're constantly evolving to what they're saying. They've relatively recently gone into caravan parks and leisure developments and things like that. And about 45, 50 years ago, Christie Finance was born, basically out of the necessity that clients were trying to buy these businesses and weren't able to obtain the funding. And Christie Finance sort of the natural growth out of that, where we speak to lenders and we've got access to the whole of the market. We've got excellent relationships with all of the lenders. We speak to them on a regular basis, and we're an FCA regulated broker. So what that means is any deal that we send out has to speak to by minimum 3 lenders to be able to prove that, audited regularly. And basically we lean very heavily on our reputation. We believe that we are best in market. We have, as I say, access to the whole of the lending market, lenders that people would not necessarily have heard of. And we've grown as a business from what we call our core offering. So commercial finance in that sense has grown into things like real estate, so buy-to-lets, commercial investments, unsecured team. So we've got a dedicated unsecured team that will look at loans for clients for sort of cash flow funding or asset finance, things like that. And we also have our corporate debt advisory. So as I said, core commercial goes up to about 5 million. Our debt advisory team can go above that. So we've got dedicated commercial brokers who can do cases that are deemed either as complicated or above sort of a loan size of £5 million. I'm not suggesting that a £7 million loan can't be relatively simple, because it can be, but you have to set some parameters somewhere.
Do you work with small providers? Because these figures that has been called out, I can only imagine like a company who is trying to perhaps enter the social care market. Their annual turnover is certainly not going to be 5 million, of course, except they raise capital in some sort of way.
I think you'd be surprised on what becomes a commercial entity and a commercial purchase. Care homes are going up in price, even if you looked at a new commercial purchase for £1 million.
Okay.
And depending on what the requirement is from the client, a lot of clients will come out and say, we're looking for maximum loan to value. That's whenever you say to a client, what is the loan you're looking for? A maximum loan to value. So, in theory, that's 70%. That's £700,000. So that's still a commercial purchase. You don't tend to see many active trading care homes below that sort of mark. You find the odd few, but in elderly care, you're probably looking around £1 million. Obviously, depending on where you are based in the country, these purchase prices will change. And also, if it is something something like learning disabilities or specialist care, you could be talking about a home that's £500,000, for argument's sake. Again, there's so many different factors to what a purchase or a refinance could look like. But I think majority of deals, you don't see very many requirements for under £500,000 for a commercial purchase or refinance. You might find the odd one or two, but most people, if they're looking to grow or looking to buy their first care home or even refinance their existing debt, £500,000 tends to be the sort of minimum that we see. You might have the odd few that might be below that, but if we're talking about a commercial property that's involved, it tends to be that sort of level. Not saying that we can't do ones that are lower than that. It's just it depends on what. If someone's just looking for £200,000 and they're looking to put a property up as part of the security package, that's absolutely fine. We'll do something like that, but you'd be surprised on the levels that people are going to. Even like first-time buyers, people are looking at their second or third homes. Prices are going up, and therefore the requirement for lending is increasing as well.
Okay. So paint me a picture. You've said a few technical terms, and I was like, when you mentioned loans of value, I leave that to my finance team to learn words like that. But little things like that, when you broke it down, it made it sound a lot more accessible to perhaps maybe a provider whose annual turnover is currently 2.5 million, and they're thinking, okay, what is going to be our growth strategy? They may not think that they could actually secure financing to grow because they don't have this insight, because some of our clients, certainly, the annual turnovers are over 1 million. And of course, there are other things to take into consideration, but they are talking about growing. But the refinancing or financing a home or a care home is an area that they shy away from, because lots of times there have been cases where people have gone into it blindly and the results hasn't really been positive. So for a provider like that, who they do have the annual turnover, all of these financial markers that you've mentioned, what would you say to them?
Let's move turnover to one side. If turnover, so that's the money that you've got coming in for the services you provide. And that's the same if you're a petrol filling station or you're a care home. It's the money coming in. When you're speaking to your accountant and you're speaking to your lenders and then eventually you speak to a broker as well, we have a look at profit and loss as one of the first things we'll look at. So your profit and loss on your annual accounts or your management accounts, if you produce them, you're going to have the certain lines that you need to look into. So turnover is a key one. Absolutely. We need to make sure that you've got money coming in. And you have things like your gross profit and your net profit and your operational income or expenditures. All these things need to be taken into consideration. A key thing that we always need to make sure is if you want to borrow money, the business that is going to be repaying this debt needs to be able to do it. So if you want to borrow £1 million and you want to borrow it over 20 years, is your business able to service that debt over that period of time? Now, lenders like to have a little bit of a buffer. So we normally look at sort of 1.5 times coverage. So in simple terms, if you're borrowing, let's say £1 million and your annual repayments were, I don't know, £50,000, a lender's going to want to show that you've got £75,000 available to repay the debt, because that gives you a 1.5 times coverage. That's where we come in. If you're looking to refinance your debt or if you're looking to purchase a new care home, we look at the financials for the target home and determine as a starting point, can this home repay the debt, or can your home repay the additional finance that you're looking to take out? Then, of course, there's lots of other parameters, which I'm sure we'll go into.
Yeah.
But if you're looking just on a pure financial basis, can your business repay the debt and still provide you with the money you need for your lifestyle? There's a lot of lenders will ask for asset and liability statement, and we do the same. And this is where we look at, so let's say I'm buying a care home and the care home gives adjusted net profit of, I don't know, £250,000. And my asset and liability statement says I need to take out of the business £50,000 a year for, my general bills, for argument's sake. That has to be taken into consideration. So there's a lot of moving parts to working out whether or not business can service the debt. And this is where a lot of providers will fall foul, because they'll say, my business is making £100,000, my debt is £90,000, I've got £10,000 over. I know I can repay that debt. And that's something that we hear a lot of. I know we can repay that debt. And of course, you probably can. The clients probably can. You know your business, you know what you need, but it's what is able to be proven to a lender. And what a lender can say, right, okay, I understand what the business is able to do, but what if base rate changes? What if there is a change in national living wages and minimum wages and things like that? And that's the big question. And what happens if? And that's why we always have to put a little bit of sort of coverage across it to make sure. Lenders have to do what's called treating their customers fairly. And part of that is making sure that they're not lending money to someone who is then going to not be able to repay the debt and get themselves in issues. You don't have to look that far back in the past to hear of lenders lending to clients then really they shouldn't have been lending the money to. And it's a difficult conversation because no one wants to say, even when I was a relationship manager, you didn't want to have to say to a client, I can't help you with this deal because you can't afford it. Because in a client's mind, of course I can afford it. I've got a vision, I've got a plan, and I want to do this.
They know they're going to put the work to make sure they meet the payment.
Yes. A good commercial broker and a good lender, it's easy saying yes. It's a lot more difficult to say no for the reasons that you might have to say. And that's what our job is to look into the deal. And a commercial broker will always look to try and do the deal. It's in our nature. That's why most brokers are brokers. We want to do deals. It's why we like doing the job. But the unfortunate truth, occasionally a deal isn't there.
So at the beginning, we mentioned that Christie Finance, you work in the care sector, well, you work with providers in the care sector. And you also mentioned that you look at the business. So we know, as from speaking to providers, one of the issues that they have is this is maybe not an issue as much anymore in the commercial space. Struggling to find financing for supported living accommodation, as an example, was very, very difficult because lenders, brokers, they didn't really understand the business. Because you mentioned that you look at the business. Can the business make money to actually pay this finance? So for a provider, for example, who currently has supported living accommodation and perhaps you wanted to grow your supported living accommodation, does Christie's Finance, do you offer some sort of consulting? Would you, because when you say you look at the business, how do you support businesses like that to ensure that you're able to finance them? Because you did say good commercial brokers like yourself, you do want to do the deal. And a lot of small providers have actually complained and said, actually, we do want to grow, but lenders, they just don't understand the business and they say no, and they're just not really helping us to even meet the demands that they want.
I think supported living is always a funny one because there's not always property in the background security. 'Cause lenders like security. A very old lender who was retiring when I was just starting told me, the key things for lending is when you're getting your money back, how you're getting your money back, and if it goes wrong, what security have you got in the background? Because unless you can answer all those three questions, you don't lend any money. And it is a key question. So is there security in the background? If the security is in the background, does it cover the loan amount by a significant amount? But the other issue that you've got is there's a lot of lenders out there and a lot of relationship managers. Banks keep changing their credit policies. They keep changing the number of staff that they've got, and they're either saying, we want to move away from a face-to-face relationship for certain clients because they want to reduce the number of sort of people they're actually seeing and things like that. So a lot of the time people will go, right, I need to get a loan. I am a first-time buyer buying a supported living business, or I'm a supported living business, and I'm going out to the lending. They might already bank with a high street lender, but they might not have any facilities, or they might only have small facilities. And their relationship manager isn't actually a specialist in that sector. And they go out to these.
But you have to have a relationship manager.
Not necessarily, but it's always going to help. But you have to have a relationship manager that's correct for your sector. You might have a business that has got an absolute requirement for a commercial relationship manager who's a specialist in that sector, but that doesn't necessarily mean that that's where you currently are. If you haven't got the lending that maybe is deemed as a commercial entity, you could be sitting with a business relationship manager who maybe has 500 customers on their portfolio, is only telephone based and doesn't know enough about your business. That's when a broker comes into play, because we have the relationships, even with your own lenders. We can go out to your own lenders, but we'll be speaking to the specialist relationship managers who know the sectors. And that is key. It is knowing the sectors and knowing the credit parameters. And one of the things that is slightly embarrassing for a lender is when a client goes to their lender declines the deal, they come to us, we end up speaking to the same lender, but a relationship manager who's actually specialized in that sector, and they agree the deal. Because then the first relationship manager looks very silly because they could have done the deal and they haven't done. And that happens more often than lenders would like to admit.
A good example would look like what? And also you spoke about credit parameters.
Yeah.
So provider listening, yeah.
Yeah, I mean, every lender has their own credit parameters. Some lenders will not touch a first-time buyer. They've just said, no, we won't look at that. If we're looking at elderly care, they'll say a lot of them will have minimum bed requirements.
Okay.
A lot of the high street will not be as high on the loan to value for new to bank entrants, and also they will have higher minimum bed numbers. So you get specialist lenders that we have to speak to who will have slightly different credit policies, but they tend to be slightly more expensive because they will look at things that are slightly more risky. Other things, and I'm sure we'll come across this and have a longer conversation about this at another stage, is the CQC. That has a huge impact on lending.
Oh, I never knew that.
Yeah, absolutely. If the lenders that will be the cheapest and in probably the higher loan to values will only lend to homes that have a CQC good.
Yes.
And, there's not the lenders that won't look at, requires improvement, and hopefully not, but, the odd inadequate. But if you're looking for a maximum loan to value and really like, a 2% interest rate plus base, but your home requires improvement, unless there's mitigating circumstances, you're going to struggle.
That makes sense.
And the problem is at the moment is how far behind the CQC is. And, by their own admission, they, you hear I was speaking to a client who has been waiting 5 years for the CQC to come back. They got requires improvement, and they struggled to change their finance for 5 years. And they, it's all based on the CQC, and things like that can really hurt.
So when it comes to CQC rating, this is so important because a lot of times, obviously, we work with providers and we know that when it comes to CQC, this is an area that some providers don't understand how important the CQC rating is. So to find out that it just doesn't only affect your ability to gain new clients, because of course, private clients, local authorities would look at that. It also affects your ability to grow financially.
Absolutely. Yeah. Definitely. It's a key parameter. One of the first, when we go out to a lender with a new proposal, especially for a care home, you have to say, what the current CQC rating is. There's no point in us going to a high street lender if it requires improvement. Well, I say that on the odd occasion, you might be able to get around it. If there's mitigating circumstances, but in general, high street lenders will not look at anything that requires improvement on a standalone basis. If there's a portfolio of care homes or smaller homes, and one of them's come out as requires improvement, but the others are good, then there's ways and means around it. But this is where we need to have that conversation, because we need to explain that to the relevant lenders, be able to get the deal that they need. So the best thing you can ever do when you're speaking to a broker is be brutally honest with yourself. We need to know all the skeletons in the closets before we go out to any lenders. Because if a lender finds something out and they come back to us and said, "We found this out, can you explain it to us?" Not only does it make the broker look silly, it questions the integrity of the client for not bringing it out to start off with. First thing you ever need to do is have a conversation with your broker and lay out all the cards onto the desk and see where we are. We'll see where we are.
I love that you spoke about the relationship between the broker and the client. So that being said, for a provider who wants to attract investments or who wants to be bought out, what do you help with the strategy in that? Where would you come in? Like, what will be the role of Chris? Or this is just something that you just don't do?
It's not really something that we get involved with. What you tend to find is Christie & Co. will be selling a business potentially, and we might get involved at that sort of stage, especially if it's, let's say, the registered manager wants to buy it off the owner or something like that. We might get involved there, but it depends what they're looking to do. If it's investment and they're looking to say, right, well, we're looking to get investment in from lenders, we're looking to get additional financing for whatever reason, depending on what they're looking for, then we might get involved, but it's not what we specialise in. It's not what we're specialists in. We're specialists in obtaining finance for clients for either purchases or expansions and things like that.
So what trends are you currently seeing right now in the care sector? Because I'm sure providers would want to know, okay, so perhaps if they're listening to the podcast and up until this point, they're thinking, okay, I want to invest. So what are the trends right now?
Well, there's probably more buyers than there are sellers out there at the moment, I would say.
Buyer's market.
It's a bit of a buyer's market because as soon as a good care home comes up for sale, people are making offers on these care homes without even viewing them to start off with.
That's dangerous.
Well, no, because what they want to get their foot in the door. And it turned into a point where sometimes, the selling agents and things like that are saying, we need to actually gauge who's serious to start off with. So make an initial bid on the documentation that you'll get sort of selling documentation that goes out. And so make an initial bid, and then we will let maybe 5 people view, and then we'll have a full best and final offer go out. But you sort of, even then, you could have 5 people bidding on a care home. only one person can buy it. So you're going to have 4 people that are disappointed. And you've seen a lot of different care homes come up onto the market. After COVID, a lot of care home providers went, do you know what, I've had enough. Especially people maybe in sort of like their later years of life decided, I can't hit this anymore. I don't want the stress of it. And it is the last probably 5 years have been very stressful for, care providers. There's been a lot of changes. The cost of living goes up. You can only realistically push as much of these costs back onto your residents. There's also a question of whether or not your local authority-led or privately led beds. I always say there's pros and cons to both. A privately led bed, you can charge more, and within reason, you can pass some of these additional costs onto this bed. But if you're a local authority, you probably have a contract in place with local council. You might not be able to increase the amount that you receive from them. But on the flip side, if a bed becomes empty, you can feel it really quickly because the council's always crying out to place people into care homes. The market itself is constantly fluctuating. It's still a market that lenders like.
Okay, that's good news.
There's inherent risks attached to it.
Well, if you would have thought because it's in care, the risks are lower. Because from layman's terms, you would think that, wouldn't you?
Yes, but the flip side of it is someone's well-being. So there's reputational risk as well. And so a lender doesn't want to lend to a care home that potentially then has, something come out in the press about something, that's just gone horribly wrong or something along those sort of lines, misconduct, anything like that. So it's lenders like, especially the high street lenders, they like experience.
So you would do due diligence on the company. I know this is a no-brainer, but from what I'm hearing, you're not only checking your CQC rating, you're also doing due diligence to check that.
I know where the number comes. A lot of lenders will. It's not always true. It can be true. It can be higher. If you've got other security in the background, you could potentially get 100% loan to value. But just have that conversation. If you speak to a broker and they just say, "Oh, I can get you 70%," without asking any other questions, that's not a very good broker. Because you need to answer all the rest of the questions first. If they come straight out and say, "Oh, I can get you 70%," without asking any other questions, no, wouldn't trust them.
Well, on that note, Neil, thank you so much for your time today. And just before you go, we would love to invite you back probably in about 6 months or a year or so. So would you love to come back and have a conversation with us? Perhaps if you have a new tool or product or something you'd like to share with us. So just scare me guess.
Yeah, happily come back.
Oh, thank you. Enjoyed this episode. We would love to hear from you. Let us know what about this episode you liked and how we can improve. Join our growing community of providers and carers who are learning new processes and technology, discovering proven best practices, growing through insights from industry experts, all from people creating real practical solutions in care. This is the Health and Social Care Business Podcast.